Imagine having the worst luck in the market. Every time you finally decide to invest, the market happens to be sitting at an all-time high. You are not buying after a big correction. You are not catching the bottom. You are putting money in right when everyone is already talking about record prices. Most people would assume that is a terrible way to invest. Now compare that with someone who seems much more careful. She does not like buying when the market looks expensive. If the S&P 500 is making new highs, she stays patient and waits for a pullback. Her rule is simple. She wants to buy after the market drops by 10%. At first glance, the second investor sounds smarter. She is not chasing prices. She is waiting for a better deal. But investing is often uncomfortable because the answer that feels right emotionally is not always the answer that works best over time. That is what I want to talk about today on Chloe Capital Brief. I'm Chloe, and on this channel, I break down investing ideas in a way that is calm, practical, and easier to actually use. As always, this is not financial advice. It is just for education and perspective. The question today is simple. Is it really dangerous to invest when the market is at an all-time high, or is waiting for the perfect dip sometimes even more costly? Let's start with two investors. The first one is Wendy. Wendy wants to invest, but she does not want to buy at record prices. So whenever the market reaches a new high, she keeps her cash on the sidelines and waits for a 10% pullback. The second one is Bridget. Bridget does not try to time the market. She invests when she has money available. But in our example, she has terrible luck. Every year, the money she invests goes in right at the market peak. If we only use intuition, Wendy should win easily. She waits for better prices, while Bridget keeps buying at the worst possible moment. But the historical data tells a more complicated story. Before we look at the research, it is important to define what Wendy is actually doing. Waiting for a dip may feel careful and disciplined, but it is still a form of market timing. When you say, I'll invest after a pullback, you are making a prediction. You are assuming the market will give you a lower entry point in the future. That prediction can fail even if the market never crashes. All the market has to do is continue rising longer than you expected. This is one of the most common traps for long-term investors. They are not always wrong about risk. They may be right that the market is expensive. They may be right that a correction will eventually happen. The problem is that eventually can be much later than they think. A market can look expensive and still keep going higher for months or even years. And during that time, the investor sitting in cash is not just waiting. They are missing returns, dividends, and compounding. Researchers at Archbridge Family Office looked at S&P 500 returns going back to 1990. They compared 3 different approaches. One approach waited for a 10% pullback from an all-time high before investing. Another approach invested immediately when the market reached a new all-time high. The third approach invested on random days. The result was surprising historically. Investing at all-time highs produced higher average returns than waiting for a dip. It even performed better than investing on random days. That feels strange because we are trained to think of all-time highs as dangerous when prices are at records. It feels like there must be more downside than upside, but an all-time high is not automatically a warning sign. In strong markets, all-time highs often come in clusters. A healthy bull market does not usually make one new high and then immediately collapse. It may make one new high, continue higher, and then make another one. That is why buying at an all-time high can sometimes work better than waiting. The high may not be the end of the move. It may simply be part of a longer upward trend. This is where the cost of waiting becomes very real. Waiting feels safe because nothing bad seems to be happening to your money. Your cash balance does not drop 20% in a bad week. You do not open your account and see red numbers everywhere. But safety has a price. Cash can protect you from volatility, but it also keeps you away from growth. If the market rises while you are waiting, the price you are afraid to buy may become the price you wish you had taken. That is the part many investors only understand after the fact. They wait for a correction. The correction does not come, and then the market moves higher. Later, when a 10% drop finally happens, the market may still be above the level where they originally refused to invest, so technically they got their pullback. But practically, they still missed the better opportunity. Now, this does not mean Bridget's experience is easy. If she invests right before a major crash, that money can fall sharply. During periods like 2000 or 2008, the market did not just dip a little. It suffered serious losses. No long-term investor should pretend that does not hurt. But Bridget has one advantage. She keeps investing. She is not relying on one perfect decision. She is building a habit over time. Some of her purchases may happen at bad prices. Some may happen at average prices. Some may happen during periods of fear when valuations are much better. Over a long enough period, the consistency matters more than the exact timing of each individual purchase. This is why a market peak today may not look like a peak later. If your time horizon is 20 or 30 years, the level that feels expensive now may look ordinary in the future. That does not make short-term losses pleasant, but it changes the way we think about entry points. The market does not reward us for feeling comfortable. It rewards patience, consistency, and the ability to stay invested through uncertainty. And this is where psychology becomes just as important as math. When the market is at a record high, many investors feel nervous. That reaction is completely normal. No one wants to be the person who buys right before a crash. In behavioral finance, this is connected to loss aversion. Losses hurt more than gains feel good. So when we imagine investing at a high and immediately watching the market fall, the emotional pain feels bigger than the possible reward. There is also regret, aversion. We are not only afraid of losing money, we are afraid of feeling foolish. We do not want to look back and think, why did I buy at the top? That fear can make waiting feel like the responsible choice. The problem is that waiting can become a habit too. At first, you wait because the market feels expensive. Then the market falls, and you wait because the news feels scary. Then the market starts recovering, and you wait because you are not sure if the rebound is real. Before long, there is always a reason not to invest. This is one of the hardest parts of investing. The perfect moment is usually only obvious after it has passed. When prices are low, the mood is often terrible. When the mood improves, prices are often already higher. That is why trying to time the market is so difficult. It is not enough to know that a correction might happen. You also have to know when to buy. And emotionally, buying during a correction can be much harder than people imagine. Another important piece of research comes from Hartford Funds. They studied what happens when investors miss the market's best days. Their finding was dramatic. Over a 20-year period, missing just the 10 best days cut total returns by more than half. Missing the 20 best days reduced returns even further. The detail that matters most is where those best days often occur. They are not always during calm, comfortable markets. Many of the strongest days happen during volatile periods, close to major sell-offs, and when fear is still high. That means an investor who waits for things to feel safe may miss the recovery. This is why I'll invest when there is more clarity. Sounds reasonable, but can be dangerous. Markets often move before the clarity arrives. By the time the headlines look better, a large part of the rebound may already be gone. So what should investors take away from this? The answer is not to invest blindly or ignore risk. The better takeaway is that consistency usually matters more than perfect timing. For many long-term investors, dollar cost averaging can be a practical way to deal with this problem. Instead of trying to decide whether today is the perfect day to invest, you invest a fixed amount on a regular schedule. This does not guarantee the highest possible return. Lump sum investing can sometimes perform better, especially when markets rise soon after you invest. But dollar cost averaging has one major strength. It reduces the emotional burden of timing. You do not need to guess whether the market is too high. You do not need to wait for the perfect dip. You simply follow the system. Some purchases will happen at higher prices. Some will happen at lower prices. Over time, the point is not to win every entry. The point is to keep participating in the market. For a lot of investors, that is the real challenge. They do not fail because they bought at the exact wrong time. They fail because fear keeps them from starting, or because they keep changing the plan whenever the market becomes uncomfortable. But there is one more layer we need to discuss. Most of the research we just talked about is based on the U.S. stock market, especially the S&P 500. The U.S. market has performed extremely well over the long term, but that does not mean investors should ignore concentration risk. When people buy an S&P 500 index fund, they often feel like they are buying 500 separate companies equally. But the S&P 500 is market cap weighted. Larger companies have a bigger impact on the index than smaller companies. So in reality, the performance of the index can be heavily influenced by a relatively small group of very large companies. In recent years, this has become especially important because mega-cap technology companies have carried a large share of the S&P 500's returns. That has been great. while those companies have performed well, but it also means the index may be less diversified than some investors assume. This does not make the S&P 500 a bad investment. Historically, it has been one of the strongest and simplest ways to participate in the growth of large U.S. companies. But investors should understand what they actually own. Owning the S&P 500 is not the same as owning the entire global stock market. A global index may include more companies, more countries, and more sectors. That broader exposure can help reduce dependence on one market or one group of dominant companies. Of course, global diversification also comes with trade-offs. The U.S. market has outperformed many international markets for a long time, so holding global exposure may sometimes feel less rewarding. But diversification is not about always owning the best performer. It is about reducing the risk of depending too much on one outcome. That is the bigger message behind today's topic. Investing is not about proving that one entry point is perfect. It is about building a strategy that can survive real life. Real life includes fear, regret, headlines, market highs, market crashes, and long periods where the right decision does not feel obvious. Waiting for a dip can feel smart, but it can also keep you out of the market for too long. Buying at an all-time high can feel uncomfortable, but historically, it has not been as destructive as many investors assume. And dollar cost averaging works because it gives you a way to keep moving without needing perfect confidence. Every time you invest, so the next time the market reaches a new high, instead of asking, is this the worst time to invest? It may be more useful to ask, do I have a long-term system that I can actually follow? Because in the end, the most successful investors are not usually the ones who guess every top and bottom. They are the ones who stay consistent long enough for compounding to do its work. If this helped you think differently about market highs and waiting for dips, let me know in the comments. And if you want more calm, data-driven investing breakdowns, subscribe to Chloe Capital Brief. I'm Chloe Dot. Thanks for watching, and I'll see you in the next one.